Chapter 16 Real Estate Finance 2 Introduction. Objectives. In this chapter, we will continue our discussion of real estate finance. At the end of this chapter, you will be able to 1. Describe the basic mechanics of money flow in the secondary mortgage market and define the major players involved in its activities. 2. Explain the process and key determinants of mortgage lending underwriting, including such decision variables as buyer income, LTV ratios, and quality of the collateral. 3. Describe the general nature of modern predatory lending practice and its most common offenses. Key terms. There are several important terms in this chapter. Remember to pay particular attention to these terms when you see them. Inflation. Loan flipping. Predatory lending. Primary market, secondary market. Redlining. Regulation Z. Subprime loan. The New York Bureau of Educational Standards requires that you spend 100 minutes studying the material in this chapter. Your course timer can be found in the upper right-hand corner of your screen. Secondary mortgage market. Definition. In the previous chapter, we discussed a number of loan types originated by lenders who lend money directly to borrowers. These lenders make up what is known as the primary mortgage market. Loans originated in the primary mortgage market can be bought, sold or traded in the secondary mortgage market. Primary lenders sell their notes to generate more money to make more loans. The secondary mortgage market consists of holding warehouse agencies that purchase a number of mortgage loans and assemble them into one or more packages of loans for resale to investors. Investors can purchase fractional interests in these loan packages or mortgage pools through the services of local stockbrokers. Discounts are used frequently in the secondary market. Entities that buy and sell mortgages negotiate on the basis of yields. Discounts are used to adjust yields so the buyers and sellers of the mortgage notes can reach agreement and make the sales. One might ask why lenders don't just keep the loans they make instead of selling them on the secondary market. That approach could work if every lender had a balance between the demand it has for loans and the supply of money to which it has access. But that is rarely the case. So, loans get sold on the secondary market in an effort to shift money from areas that have a surplus to those areas that have a shortage. Shifting mortgage funds. Mortgage funds can be shifted to where they are most needed in a variety of ways. Lenders can sell loans to one another. For example, a New York Savings and Loan Association has a higher demand for loans than it can meet. A Savings and Loan Association in Illinois has a surplus of deposits and a low loan demand. If the New York Savings Bank sells loans to the Illinois Savings Bank, the New York Bank would get the money it needs to make new loans, while the Illinois Bank gets to invest its surplus funds. One institution can sell a part interest and a block of loans to another institution. This is called participation. Using our example from above, New York has $5 million in loans to sell to Illinois. Instead of selling the entire block, New York could sell 90% interest, $4,500,000, and retain the other 10%. In this situation, New York would still service the loans and then pass 90% of the mortgage payments to the Illinois Bank. A more common way of shifting funds is through the use of mortgage-backed securities, which are backed by a pool of mortgages. Governmental, quasi-governmental, or private entities purchase mortgage loans from banks, mortgage companies, and other originators and then assemble them into pools. The entity then issues securities that represent claims on the principal and interest payments made by borrowers on the loans in the pool. Secondary market players. Important players in the secondary mortgage market are Ginnie Mae, Government National Mortgage Association, a government agency. Fannie Mae, Federal National Mortgage Association, a former government agency that became a private corporation in 1968. Freddie Mac, Federal Home Loan Mortgage Corporation, a quasi-government agency. These agencies, collectively known as government-sponsored enterprises, purchase loans or guarantee mortgage-backed securities issued by lenders. Ginnie Mae, Ginnie Mae is a division within the Department of Housing and Urban Development. Its basic mission when it was established in 1968 was to create and operate a mortgage-backed security program for the Federal Housing Administration and Department of Veterans Affairs mortgages. Ginnie Mae developed the first mortgage-backed security in 1970. This security was backed by a pool of HA and VA mortgages. It was called a pass-through security because the monthly principal and interest payments were collected from the borrowers and then passed through to the investors. Ginnie Mae doesn't purchase mortgages. It guarantees that the monthly payments will be made every month. Because Ginnie Mae is a government agency, its guarantee is backed by the full faith and credit of the United States government. In return for this guarantee, Ginnie Mae collects a small fee from the lender every month. As we said earlier, mortgage-backed securities are pools of mortgages that are used as collateral for issuing securities called pass-through certificates. There are three types of mortgage-backed securities. Straight pass-through: the security holder receives the actual principal and interest payments as they are received from the mortgages in the pool. Modified pass-through: the security holder receives the interest portion of the payment, whether or not it has been collected, and the principal payment when it is collected. Fully modified pass-through: the security holder receives payment of both principal and interest, whether or not it has been collected. Ginnie Mae. Ginnie Mae has two types of mortgage-backed securities programs. Ginnie Mae MBS are based on single-family pools and are Ginnie Mae's most heavily traded MBS product. The underlying mortgages generally have the same or similar maturities and the same interest rate on the mortgages. Ginnie Mae payments are made to holders on the 15th day of each month. The minimum pool size is $1 million. A pool must consist of mortgages within one of these categories: single-family level payment mortgages, single-family buy-down mortgages, single-family graduated payment mortgages, single-family growing equity mortgages, manufactured home loans, project construction loans, including multifamily residential, hospital, nursing home, and group practice facility loans, project loans, including multifamily residential, hospital, nursing home, and group practice facility loans. Ginnie Mae. Ginnie Mae 2 MBS are modified pass-through mortgage-backed securities. An issuer may participate in the Ginnie Mae 2 MBS either by issuing custom, single-issuer pools or through participation in the issuance of multiple issuer pools. A custom pool has a single issuer that originates and administers the entire pool. A multiple issuer pool typically combines loans with similar characteristics. Loans with different interest rates may be included in the same pool or loan package, except in the manufactured home loan program where a different rule is applicable. The Ginnie Mae 2 MBS have a central paying and transfer agent that collects payments from all issuers and makes one consolidated payment, on the 20th of each month, to each security holder. Any one pool must consist of only one of the following mortgage types: single-family level payment mortgages, single-family graduated payment mortgages, single-family growing equity mortgages, manufactured home loans, single-family adjustable rate mortgages. The minimum pool size is $1 million for single-family pools, $350,000 for manufactured home pools, and $500,000 for all other pool types. Fannie Mae. Fannie Mae is a shareholder-owned company that works to make sure mortgage money is available for people across the country. Fannie Mae does not lend money directly to home buyers. They work with lenders to make sure the lenders don't run out of mortgage funds. Fannie Mae stock is actively traded on the New York Stock Exchange and other exchanges and is part of the Standard & Poor's 500 Composite Stock Price Index. Fannie Mae operates under a congressional charter directing them to channel their efforts into increasing the availability and affordability of homeownership for low, moderate, and middle-income Americans. Fannie Mae receives no government funding or backing. Some history. In 1938, the federal government established Fannie Mae to increase the flow of mortgage money by creating a secondary market to purchase Federal Housing Administration insured mortgages. After World War II, Fannie Mae's authority was expanded to include VA-guaranteed mortgage loans. At that time, Fannie Mae purchased FHA and VA loans at par, meaning at full face value. The Charter Act of 1954 rechartered Fannie Mae by removing government backing for money borrowed to fund Fannie Mae's secondary market operations and allowing Fannie Mae to finance through private capital. Fannie Mae could now sell its mortgages in addition to purchasing new loans. Where previously Fannie Mae had purchased at par, now purchases could be made at whatever discounted price would give a reasonable rate of return. In addition, Fannie Mae could now establish its own criteria for accepting a mortgage that was submitted to it for sale. It did not have to purchase every submitted mortgage. Fannie Mae. When Fannie Mae purchases mortgages, they execute a servicing agreement which allows the loan originator to be the collection agent and receive a fee. The loan originator can receive a potentially substantial income from these fees, which range from 1/4 to 3/8 of 1% of the loan amount. Obviously, the greater the size of the loan portfolio, the greater the income for the loan originator. When Fannie Mae sells mortgages, it does so in open market transactions. Purchasers must pay current prices for the securities in these transactions. Sales of Fannie Mae mortgages usually peak when there are limited opportunities for other investments. Under the 1968 Charter Act, Fannie Mae became a fully private company operating with private capital on a self-sustaining basis. As a separate, privately owned corporation, Fannie Mae became subject to federal corporate income tax, but it was exempt from state income taxes. Its role was expanded to buy mortgages beyond traditional government loan limits, reaching out to a broader cross-section of Americans. Fannie Mae could purchase mortgages at premium, which is in excess of par, and was given the authority to issue mortgage-backed securities. The 1968 Act also provided for continuing HUD oversight of Fannie Mae to ensure Fannie Mae's adherence to its public purpose. Fannie Mae. The Emergency Home Finance Act of 1970 gave Fannie Mae the authority to deal in conventional mortgages. However, several eligibility restrictions and/or risk-sharing requirements were imposed on the mortgages Fannie Mae could buy in order to ease any credit concerns raised by the acquisition of conventional mortgages. This new law also required the HUD Secretary to provide prior approval of Fannie Mae's purchase of conventional mortgages. The Secondary Mortgage Market Enhancement Act of 1984 clarified and modified several of HUD's regulatory powers over Fannie Mae. It required HUD to respond within 45 days to any request for new program approval made by Fannie Mae under the 1968 Charter Act, and authorized Fannie Mae to purchase and deal in subordinate lien mortgages. Fannie Mae MBS. Fannie Mae pools loans that generally conform to their standards and converts them into single-class mortgage-backed securities known as Fannie Mae MBS, which they then guarantee as to timely payment of principal and interest. The mortgages that back a Fannie Mae MBS are held in a trust on behalf of Fannie Mae MBS investors and are not Fannie Mae assets. As a Fannie Mae MBS investor, the certificate holder receives a pro rata share of the scheduled principal and interest from mortgagors on the loans backing the security. Interest is paid at a specific interest rate. The certificate holder also receives any unscheduled payments of principal. Fannie Mae. Fannie Mae Guidelines. Any lender wanting to sell loans to Fannie Mae must conform to their guidelines. Some of the guidelines include the following. Loan limits. Fannie Mae sets loan limits which are linked to the Federal Housing Finance Board's October Single Family Price Survey. These loan limits are adjusted each year in accordance with the results of this housing survey. Debt-to-income ratio. A borrower's monthly debt payments cannot exceed 28% of the monthly income. PMI. Any loan made that has a loan-to-value ratio of more than 80% must carry private mortgage insurance. Gifts. Funds from gifts may be used as all or part of the 20% down payment. Seller down payment. If the borrower has a 5% down payment, a seller can contribute up to 3% of the closing costs. Seller contribution goes up to 6% if the down payment is 10%. Fannie Mae. As we mentioned on the previous screen, Fannie Mae sets limits for its loans. Any loan that falls within these limits and meets other Fannie Mae guidelines is called a conforming loan. As we said, the loan limits are adjusted each year in January and are based on the average home price for single-family homes financed by conventional mortgages. As of January 2020, the loan limits are as follows. First mortgages. One-family home, $510,400. Two-family home, $653,550. Three-family home, $789,950. Four-family home, $981,700. Note: 1 to 4 family mortgages in Alaska, Hawaii, Guam, and the U.S. Virgin Islands are 50% higher than the limits for the rest of the country. Maximum loan amount for high-cost areas for 2020. One family home, $765,600. Two-family home, $980,325. Three-family home, $1,184,925. Four-family home, $1,472,550. There are high-cost areas within the following states: California, Colorado, Connecticut, District of Columbia, Florida, Georgia, Idaho, Maryland, Massachusetts, New Hampshire, New Jersey, New York, North Carolina, Pennsylvania, Tennessee, Utah, Virginia, Washington, West Virginia, Wyoming. Loans that don't meet the Fannie Mae guidelines, including the loan limits above, are called non-conforming loans. Even though Fannie Mae sets loan limits, a purchaser may pay any price for a property and make up the difference in cash. Any loan that exceeds the conforming loan limits is called a jumbo loan. Jumbo loans usually have a higher rate of interest, may require a larger down payment, and vary in qualifying ratios and other underwriting criteria. There is a strong secondary market for packages of these larger loans, but individual investors will set their own standards. Check your understanding. Print this screen, answer the questions, and then advance to the next screen to see the answers. 1. What is the role of the secondary mortgage market? 2. Who are the three major players in the secondary mortgage market? 3. What was the first mortgage-backed security called and why was it called this? 4. Why did the federal government establish Fannie Mae? Check your understanding. Answers 1. What is the role of the secondary mortgage market? The secondary mortgage market consists of holding warehouse agencies that purchase a number of mortgage loans and assemble them into one or more packages of loans for resale to investors. 2. Who are the three major players in the secondary mortgage market? Ginnie Mae, Fannie Mae, Freddie Mac. 3. What was the first mortgage-backed security called and why was it called this? It was called a pass-through security because the monthly principal and interest payments were collected from the borrowers and then passed through to the investors. 4. Why did the federal government establish Fannie Mae? The federal government established Fannie Mae to increase the flow of mortgage money by creating a secondary market to purchase Federal Housing Administration insured mortgages. Freddie Mac. As we have discussed, Ginnie Mae and Fannie Mae were created to deal primarily with the purchase of FHA and VA loans. Because of this, there was a need to develop a mortgage-backed security for conventional loans. In 1970, the Federal Home Loan Mortgage Corporation, known as Freddie Mac, introduced the first security backed by conventional loans. Similar to Ginnie Mae and Fannie Mae, Freddie Mac buys conventional loans from savings banks, commercial banks and mortgage companies, assembles the loans into a pool of mortgages, and issues a security backed by the mortgages. This security is called a participating certificate or guaranteed mortgage certificate. Freddie Mac's mission is to provide stability, affordability and opportunity to the housing market. Freddie Mac is dedicated to putting homeownership within reach for minority populations. In addition, Freddie Mac strives to make rental housing more affordable through its Program Plus, Standard Lease-Up and Premier Lease-Up mortgage programs for multifamily housing. Freddie Mac Guidelines. Similar to our earlier Fannie Mae discussion, Freddie Mac has guidelines to which lenders must conform. These guidelines include loan limits. Loan limits are linked to the Federal Housing Finance Board's October Single-Family Price Survey. These loan limits are adjusted each year in accordance with the results of this housing survey and apply to 1 to 4 unit residences. PMI. Any loan made that has a loan-to-value ratio of more than 80% must carry private mortgage insurance. Gifts. Funds from gifts may be used as all or part of the 20% down payment. Seller down payment. If the borrower has a 5% down payment, a seller can contribute up to 3% of the closing costs. Seller contribution goes up to 6% if the down payment is 10%. Truth in lending. Finding the right loan can be a complicated task for buyers. They must compare the costs of the loans and look at the structure of each to see how the particular features will work for them both now and in the long term. When comparing loans, it's not enough to just look at the interest rates. The buyers must also consider the loan fees and other charges. There is a federal law in force, the Truth in Lending Act, to help buyers make those comparisons. The Truth in Lending Act, Title I of the Consumer Credit Protection Act, is implemented by Regulation Z. This law requires lenders to disclose to buyers the true cost of obtaining credit, so that borrowers can compare the costs of various lenders. Regulation Z applies to all loans that are secured by a residence. It does not apply to commercial loans. Agricultural loans over $25,000. The provisions of Regulation Z cover disclosure of costs, right to rescind the transaction, advertising offers, non-compliance penalties. Disclosure. The lender must disclose all finance charges and the annual percentage rate of the loan. Finance charge disclosure includes loan fees, interest, service charges and points. For home mortgages, the lender must disclose the APR but is not obligated to disclose the total interest payable over the life of the loan. Truth in lending. Right to rescind. In most cases, the borrower has a right to cancel the transaction by notifying the lender within 3 days. This does not apply to residential first mortgage loans, but does apply to refinancing and home equity loans. Advertising. Any advertising is subject to Regulation Z disclosure if it contains any of the following items: amount or percentage of down payment, installment payment or amount, specific finance charge, number of installments, period of repayment. Indication that there is no charge for credit. If an ad includes any of the above items, all of the following items must be disclosed: the amount or percentage of down payment, terms of repayment, annual percentage rates and if increase is possible, total finance charge, total number of payments and due dates. Regulation Z applies to advertising in all media, including websites, billboards, radio, TV and direct mailings. Penalties. It is especially important that licensees not violate the advertising requirements of Regulation Z. The penalty for violation is twice the amount of the finance charge or a minimum of $100, up to a maximum of $1,000. The violator could also be liable for court costs, attorney fees and any actual damages. Willful violation of Regulation Z is a misdemeanor that is punishable by a fine of up to $5,000 or 1 year in prison or both. Lenders' criteria for granting a loan. Lenders base their decisions about whether or not to grant a loan on the following criteria: the economy, the investment quality of the property, the borrower's ability to repay the loan. Let's look more closely at each of these. The economy. The state of the economy plays a large role in the loan process. One important factor is inflation. Inflation can be caused by either too few goods offered for sale or too much money in circulation. When housing and mortgages are in high demand and inflation is on the rise, demand for credit rises greatly. When home prices rise, the cost of borrowing increases. So, generally speaking, inflation is not good for the real estate market. Investment quality of the property. Usually the lender will first determine the ability of the borrower to repay the loan, which we will talk about in detail on the next several screens. Once the lender has determined that the borrower is qualified to receive a loan, the lender will move on to the job of qualifying the property to determine if the property is a good risk. Even though the evaluation of the borrower's qualifications is the primary factor in the loan decision, lenders realize that life happens. In the long-range scheme of things, borrowers lose jobs, get divorces, and file bankruptcies. In order to lessen this risk, lenders need to determine the value of the property as collateral in the event that something unforeseen happens. It is important for the lender to determine the market value of a particular piece of property at any given point in time. Since the value of a piece of property changes from one point in time to another, each piece of property must be inspected and appraised carefully to get a proper estimate of its market value. Depending on what type of loan the lender wants to issue and the current loan-to-value ratio, the lender will base the loan amount on either the amount of the appraisal or the sales price, whichever is less. Lenders who are active in the real estate market usually have experienced appraisers on their staff who are charged with estimating and verifying property values. Lenders who are not as active in the real estate market hire professional appraisers to get an opinion of the property. Loan-to-value ratios. A loan-to-value ratio, also referred to as LTV, is the ratio of the mortgage principal to the value of the property the borrowers are purchasing. Let's say the buyers are purchasing a home for $120,000. They are making a $24,000 down payment and borrowing $96,000. The loan-to-value ratio in this scenario is 80%. The borrowers are making a 20% down payment and borrowing 80% of the home's value. If these same borrowers were making a $12,000 down payment on the same loan, the LTV would be 90%, since they would be making a 10% down payment and borrowing 90% of the home's value. As you can see, a higher LTV means a larger loan amount is being borrowed and a smaller down payment is being made. Most lenders feel that if the borrowers have a greater amount invested in the property, the down payment, the less likely they will be to default on the loan and lose the property. In addition, if the borrowers do default, the loan balance will be smaller, so the lender will have a better chance of recovering the loan balance in the foreclosure sale. Lenders use LTVs to determine the maximum amount of their loans. In some loan programs, the lender might set the maximum loan amount at 90%, requiring the borrower to make a down payment of 10%, while other programs might allow a maximum of 95%, meaning the borrowers would only have to come up with 5% for the down payment. Type of property. The lender will also consider the type of property when making a loan decision. Is it an income-producing rental or will it be owner-occupied? If the 1 to 4 unit dwelling is a rental unit, the lender can consider part of the rent in its evaluation of the borrower's income, and that may qualify the borrower for a higher loan amount. If the dwelling is owner-occupied, the lender may think the risk is less because the property will be better taken care of. In this case, the lender may require a smaller down payment. On the other hand, if the residence is a rental, the lender may require a larger down payment. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Why was Freddie Mac created and what is its mission? 2. What is the basic purpose of truth in lending, Regulation Z? 3. What is the right to rescind and what is not covered by this rule? 4. Jake and Myra Smith are purchasing a $150,000 home. They are making a $15,000 down payment and getting a loan for the balance. What's the loan-to-value ratio? Check your understanding. Answers 1. Why was Freddie Mac created and what is its mission? Freddie Mac was created in 1970 to develop a mortgage-backed security for conventional loans. Freddie Mac's mission is to provide stability, affordability and opportunity to the housing market by putting homeownership within reach for minority populations and making rental housing more affordable. 2. What is the basic purpose of Truth in Lending, Regulation Z? Give buyers information about the true cost of obtaining credit, so that borrowers can compare the costs of various lenders. 3. What is the right to rescind and what is not covered by this rule? The borrower has a right to cancel the transaction by notifying the lender within 3 days. This does not apply to residential first mortgage loans. 4. Jake and Myra Smith are purchasing a $150,000 home. They are making a $15,000 down payment and getting a loan for the balance. What's the loan-to-value ratio? The loan-to-value ratio is 90%. They are making a 10% down payment and getting a 90% loan. Borrower's ability to repay. Lenders qualify buyers using what are called qualifying standards or loan underwriting standards. Underwriting will determine whether a borrower and property meet the minimum requirements established by the lender, the investor or the secondary market. Underwriting is usually performed by a loan officer or other person employed as an underwriter and is based on information contained in the borrower's loan application and an appraisal of the property. The analysis is usually made in the context of a lending policy or guidelines that the particular institution specifies. In some cases, the lender will require the borrower to obtain default insurance. The borrower purchases this insurance policy to protect the lender from potential losses if the borrower defaults on the loan. In those cases, either the lender is not willing to bear the total risk of the borrower default or the lender may be planning to sell the loan to a third-party investor. If the lender plans to sell the loan to a third-party investor, the lender must consider the underwriting standards those other investors require. Otherwise, the lender may lose the option of selling mortgages later. Underwriting process. Once the borrower has submitted a loan application to a lender, the actual underwriting process begins. The underwriter must evaluate the borrower's ability to repay the loan. As we said earlier, one of the principal risks a lender undertakes is the fact that the borrower might default on repayment of the loan and that the borrower will damage the value of the property as security. In addition, the lender runs the risk that, in the event of a foreclosure, the sales proceeds from the property will not be enough to cover the lender's loss. To qualify for a mortgage loan, a borrower must meet the lender's qualifications in terms of income, debt, cash, and net worth. In addition, the borrower must demonstrate sufficient creditworthiness to be an acceptable risk. Let's look at each of the lender's criteria and see how it is analyzed. Income analysis. An underwriter must do a careful analysis of the borrower's income to determine if, in fact, the borrowers can afford the monthly payment for the property they want to buy. When an underwriter is looking at an applicant's income, he or she must decide. So, the underwriter is apt to give income from this source a high score. On the other hand, what if the applicant works for a new, small business that is just starting up in the area? Since the new company does not have an established track record in the area, the underwriter will probably give this income a lower score. Income is also judged on its permanence, in other words, how long it can be expected to continue. Income that comes from permanent employment, government benefits, or some types of investment interest or dividends is favorably viewed. On the other hand, income from temporary employment or unemployment benefits is not considered stable enough for major consideration. Acceptable income. There are some other guidelines that lenders use to determine if income is stable. It varies according to the type of employment. Let's take a look. Permanent employment. This is typically judged to be stable if the applicant has been employed continuously for 2 years or more in the same field. But there are always extenuating circumstances. So, each applicant's situation is carefully reviewed. If an applicant is a recent college graduate, for example, his or her lack of continuous employment could be given less weight. If an applicant has changed jobs a few times in the past few years, how the lender views this will be circumstance dependent. If the changes were to advance in the same field, the lender will see this as favorable. But if the changes were from one company to another with no change in status, the lender might consider it a sign that the applicant has employment problems. Self-employment. This has always been a complicated road to take. Reliable income from self-employment is hard to document unless the person has been self-employed for a number of years. Lenders have more stringent standards for the self-employed. Obtaining financing for an applicant who has been self-employed for less than 2 years is extremely difficult. It is usually only possible if the applicant has been employed in the same field for some time and can show through feasibility studies or market research that his or her business has a good chance of future success. Acceptable income. Other income. Often lenders will consider other forms of income as stable if they have been a regular part of the applicant's income for at least 1 to 2 years. This could be in the form of bonuses, commissions, or wages from a part-time job. Typically, overtime is not considered to be stable income, unless the applicant can prove that it has been regular and consistent for some period of time. Sole proprietorship, partnership, or corporation. If the applicant's income comes from a business entity, the lender will want to know how that business is organized. If the business is a sole proprietorship and the applicant is the owner, then the applicant controls the income, and the self-employment guidelines we talked about earlier come into play. If the business is a partnership, there are others who have an income interest in the business. The applicant will not have full control of the income and its distribution. The vote of the stockholders controls a corporation's business income. If the applicant does not receive a salary or dividends, verifying income will be difficult. Income verification. The loan officer who will be doing the underwriting will verify all of the information included on the application by actually contacting the references given. The borrower will usually sign a verification form that allows the lender to collect the employment information. There is a form called Request for Verification of Employment that most lenders use. By signing this form, the borrower authorizes his or her employer to reveal confidential information about his or her job status. The information includes the borrower's wages and length of employment. The employer will also be asked to give an opinion of the borrower's attitude on the job, the probability of continued employment, and a prediction of what the borrower's prospects are for pay increases or promotions. Alternatively, the lender could choose to collect W-2 forms and pay stubs from the applicant and then verify the information with the employer through a phone call. Verifying other income. For income that does not come directly from an employer, the lender will use other verification methods. The lender may require copies of federal income tax returns for the previous 2 years to verify income from commissions or self-employment. Self-employed applicants may have to provide audited financial statements. The lender may require copies of court orders to verify alimony or child support income and copies of bank statements to show the money was received and deposited. Landlords may have to submit copies of their ledgers for their rental properties, along with tax returns showing the income. Income ratios. Once the lender has established the applicant's monthly income, it's time to determine if that income is enough to pay a loan. The lender will do this by establishing an income ratio and a debt ratio. The income ratio establishes the borrower's capacity to pay by limiting the percent of gross income a borrower may spend on housing costs. Housing costs include the principal, the interest, the taxes, and homeowner's insurance, and may also include some monthly assessments for mortgage insurance and utilities. Conventional loans typically require this ratio to be under 28%. But FHA guidelines require the income ratio to be no more than 29%. A borrower's debt ratio is calculated based on all of the monthly obligations the borrower has, including those items or payments the borrower must make for other debts. These debts could be car payments, revolving charge accounts, etc. Conventional loans usually require the debt ratio be 36% or lower, but FA guidelines state the debt ratio may not be greater than 43%. Note: each loan program has its own income ratio requirements. Net worth. The underwriter will examine the assets and liabilities section of the borrower's application very carefully. The information about the borrower's net worth is important to the lender as it gives an indication of the borrower's ability to keep up the payments on the loan in the event that the borrower would lose his or her job. This could be especially important in a case where the buyer's income is not as good quality as the lender would like. Significant net worth could make the difference in whether or not the loan gets approved. If the buyer's net worth is predominantly cash, the lender will be very encouraged. In such a case, it becomes much more likely that the buyers have the funds they need for the down payment, closing costs and whatever other expenses they might encounter in the purchase of the property. Some lenders require that applicants have a reserve of cash after the purchase is complete, enough to cover a few months' mortgage payments in the event of a temporary financial crisis. It raises the lender's comfort level to know that the chances of a default during an emergency are greatly reduced with cash reserves. A buyer's net worth is determined simply by subtracting debts from assets. Credit history. At the same time the underwriter is reviewing financial and employment information, the underwriter will also send a request for a borrower's credit reports. The credit report can be ordered from any of the 3 major credit reporting agencies: Equifax at, Experian at, TransUnion at. The lender should receive the reports within a few days. Each report will usually have a borrower's age, his or her address, whether the borrower is a tenant or an owner of a residence, the amount of time the borrower has lived at the current address, a brief employment history, and a profile of the person's credit, both past and present. Most of this data is collected from banks, merchants and other credit services. The credit report is a compilation of the information that's accumulated by not only checking the information on the application, but also by checking public records to discover if there's anything pending against the borrower, such as lawsuits, judgments, bankruptcies, foreclosures, wage garnishments or defaults. The credit report indicates the status of current and past accounts. It indicates the dates that payments were made and how regularly they were made, whether or not they were delinquent or if there are any outstanding balances. The borrower's payment history is the most important part of the report. Lenders frequently believe that a person's future actions reflect past behavior when it comes to finances. Research indicates that slow payers generally remain slow payers. Conversely, persons who are prompt in their payments usually remain so in the future. Evaluating the borrower's credit report. Even though lenders use many standardized forms in the lending process, the analysis and evaluation of the borrower's creditability is still the area where there is the greatest amount of interpretation. In addition, if the borrower's credit report shows a pattern of late or missed payments, the loan processor would probably recommend that the loan be denied and the file closed without further evaluation. However, if the credit report shows just a few late payments and everything else looks good, the lender will probably give the borrower a chance to explain those entries. If the borrower can convince the lender that any problems in the past were temporary and will not recur, the lender could well choose to approve the application. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Define underwriting. 2. What kinds of income are considered stable income? 3. How does a lender determine if the buyer's income is enough to pay the loan? 4. Why is information about net worth important? Check your understanding. Answers. 1. Define underwriting. The evaluation process used to determine the borrower's ability to repay a loan and estimate the value of the property being used as collateral. 2. What kinds of income are considered stable income? Permanent employment. Self-employment under certain conditions. Employment that has generated a regular income for at least 1 to 2 years, such as bonuses or commissions. Some income from secondary sources, such as rental income or investments. 3. How does a lender determine if the buyer's income is enough to pay the loan? By establishing an income ratio and a debt ratio. 4. Why is information about net worth important? It gives an indication of the borrower's ability to keep up the payments on the loan in the event that the borrower would lose his or her job. Predatory lending. Today's rate of successful homeownership has been threatened by predatory lending practices. When a qualified borrower is approved for a mortgage loan, the loan is referred to as A paper. A less qualified borrower, perhaps one with credit problems, may have to take a loan at a higher rate of interest, referred to as B paper. More serious credit problems might lead to C paper, and there is even a category of D paper for those with overwhelming credit problems. Borrowers who fall into the below A categories are referred to as subprime borrowers. Although there is a secondary market for these less than A paper loans, they are often kept in portfolio by the originating lenders. Some lenders today might insist on a B-type loan to start with but agree to review the case in 1 or 2 years. If the borrower has a solid track record of regular payments and no further credit issues have arisen, the lender might upgrade the loan to an A position and lower the interest rate. It is more beneficial for the lender to keep this now qualified borrower on the books rather than to have that person refinance with another lender. Predatory lending. A predatory lender is one that literally preys on the customers who may fall into the B, C, or D lending categories, particularly those who do not speak English, are poorly educated, or are elderly. Predatory lending practices can leave victims homeless and defeated, stripped of self-respect and hope, their credit ruined. Predatory lending practices typically involve one or more of the following: basing an unaffordable loan on the applicant's assets rather than his or her ability to repay the loan. Encouraging a borrower to refinance a loan so that the lender can charge high points and fees for the new loan. This is called loan flipping. Sometimes the borrower also pays a higher interest rate than with the original loan. Using fraud or deception to hide the true obligations of the loan from the borrower. Subprime loans. When lenders provide loans to unqualified home buyers, those who have poor credit and whose ability to repay the loan is risky because of their income, those lenders are giving subprime loans. Here are some of the predatory lending practices that one might see with subprime loans. Lenders charge higher interest rates and higher closing costs to make up for the loss they might suffer if the borrower defaults. Most home loans have fees that are less than 1% of the loan amount. A predatory loan can have loan fees in excess of 5%. These excessive costs are tucked into the loan amount so the lender can easily disguise them. Predatory lenders often add insurance and other unnecessary products to the loan amount. The insurance they require can include regular mortgage insurance, fire and hazard insurance, life insurance, disability insurance, homeowners insurance and health insurance. A lender could require a higher down payment from the unqualified buyer because of the type of neighborhood in which the property is located. This is known as redlining and violates fair housing laws. As many as 80% of subprime mortgages may have an abusive prepayment penalty, which often equals 5% of the original loan as compared to 2% on other home loans. This penalty is so high that it eats up any equity the homeowners have built up and can even leave them owing more money. Homeowners often are trapped into keeping the original, high-interest mortgage, instead of being able to refinance to get a lower interest rate and lower payment. More predatory lending. Balloon loans. As we discussed in the previous chapter, a balloon mortgage is a loan that has one large final payment due when the loan matures. Since balloon payment loans are partially amortized loans, the monthly payments are not large enough to fully amortize the loan by the end of the term, leaving the large balloon payment due. The major problem with a balloon payment loan is that the borrower has to come up with a large sum of money at the end of the term. If the borrower has made his payments on time, the lender can choose to extend the balloon payment for another term. However, in some cases, the lender may require an even higher interest rate for the extension. If the borrower doesn't have the income to meet the higher payment, he will be in trouble and possibly face foreclosure. Loan flipping. As we mentioned earlier, loan flipping generally refers to repeated refinancing of a mortgage loan within a short period of time with little or no tangible net benefit to the borrower. Lenders who flip loans tend to charge high origination fees with each successive refinancing and may charge these fees based on the entire amount of the new loan, not on just the incremental amount added to the loan principal through the refinancing. In addition, each refinancing may trigger prepayment penalties, which could be financed as part of the total loan amount, adding to the borrower's debt burden. More predatory lending. Debt consolidation and home equity loans. Predatory lenders also take advantage of homeowners who want to do debt consolidation using a home equity loan. But there can be a downside to debt consolidation. Once a borrower consolidates other loans with his or her home payments, the borrower could actually lose the home for not having enough money to pay off a credit card or make the car payment. If those payments remain separate, that can't happen. Another example of predatory lending in home equity loans would be an unscrupulous lender who convinces an elderly widow to place a home equity loan on her property in order to obtain cash, even though the lender is fully aware that she will never be able to repay the loan. At some point, the lender forecloses and the widow loses her home and all of her earlier investment in the home. As you can see from our discussion on the previous few screens, it is very easy for predatory lending practices to lead to a high number of home foreclosures. New York Anti-Predatory Lending Law. The New York Anti-Predatory Lending Law puts considerable restrictions on high-cost subprime loans that are either first or second mortgages. The loans that are covered by this law are those that meet all of the following criteria. Have a principal amount up to a maximum of $300,000. Are for personal or family purposes. Are secured by a 1-4 unit residence that is or will be the borrower's principal residence. The loan must also exceed one or more of the following. If it is a first mortgage, the annual percentage rate of the home loan exceeds 8%. If it is a second mortgage, the annual percentage rate of the loan exceeds 9%. If the loan is a conventional loan for more than $50,000, the total points and fees exceed 5% of the loan. If the loan is an FHA or VA loan for more than $50,000, the total points and fees exceed 6% of the loan. If the loan is less than $50,000, the total points and fees exceed 6% of the loan, or $1,500, whichever is greater. New York Anti-Predatory Lending Law. These restrictions also apply. A lender may not charge a borrower a fee to modify, renew, extend or amend a high-cost loan. A lender may not include oppressive mandatory arbitration clauses. A lender may not finance single premium insurance. A lender may not refinance a special mortgage without prior counseling from a HUD-approved counselor. A lender must provide a written notice and list of approved counseling services to borrowers prior to the loan closing. In a complaint initiating foreclosure of a high-cost home loan, the lender must show that the loan terms comply with the Anti-Predatory Lending Law. In addition, the lender must prove such compliance to the court's satisfaction, even if the borrower defaults in the foreclosure proceeding. Penalties for violations. A borrower can bring an affirmative action against a lender or mortgage broker within 6 years from the date of the loan origination. The borrower can raise violations of the law at any time as a defense to a foreclosure action. If the borrower proves that the lender or broker violated the law, the borrower is entitled to actual damages, attorney's fees, and statutory damages. A borrower may also be granted declaratory and injunctive relief. Furthermore, if the court finds that the lender intentionally violated the law, the loan will be made void, and the borrower may recover any payments made under the agreement. If the court finds that the lender violated any provision of the law, the loan may be rescinded. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Define the term predatory lender. 2. Why is a balloon loan a particularly bad idea for a low-income borrower? 3. What is loan flipping? 4. List 3 prohibited practices of the New York Anti-Predatory Lending Law. Check your understanding. Answers 1. Define the term predatory lender. A predatory lender is one that literally preys on the customers who may fall into the below A paper lending categories, particularly those who do not speak English, are poorly educated or are elderly. 2. Why is a balloon loan a particularly bad idea for a low-income borrower? The major problem with a balloon payment loan is that the borrower has to come up with a large sum of money at the end of the term. In some cases, the lender requires an even higher interest rate to give an extension. If the borrower doesn't have the income to meet the higher payment, he or she will be in trouble and possibly face foreclosure. 3. What is loan flipping? Encouraging a borrower to refinance a loan so that the lender can charge high points and fees for the new loan. 4. List 3 prohibited practices of the New York Anti-Predatory Lending Law. The lender cannot lend to unqualified borrowers. Lenders and brokers must verify sources of income. A lender may not finance points and fees that exceed 3% of the total loan amount. A lender may not refinance an existing home loan unless the new loan provides a tangible net benefit to the borrower. Summary review. This concludes Chapter 16. Below is a summary which you can review before taking your quiz. Lenders who lend money directly to borrowers make up what is known as the primary mortgage market. Loans originated in the primary mortgage market can be bought, sold or traded in the secondary mortgage market. Primary lenders sell their notes to generate more money to make more loans. Important players in the secondary mortgage market are Ginnie Mae, Government National Mortgage Association, a government agency. Fannie Mae, Federal National Mortgage Association, a former government agency that became a private corporation in 1968. Freddie Mac, Federal Home Loan Mortgage Corporation, a quasi-government agency. Ginnie Mae is a division within the Department of Housing and Urban Development. Its basic mission when it was established in 1968 was to create and operate a mortgage-backed security program for the Federal Housing Administration and the Department of Veterans Affairs mortgages. Fannie Mae is a shareholder-owned company that works to make sure mortgage money is available for people across the country. Fannie Mae does not lend money directly to home buyers. They work with lenders to make sure the lenders don't run out of mortgage funds. Fannie Mae sets limits for its loans. Any loan that falls within these limits and meets other Fannie Mae guidelines is called a conforming loan. Loans that don't meet the Fannie Mae guidelines are called non-conforming loans. Summary review. Summary. In 1970, the Federal Home Loan Mortgage Corporation, known as Freddie Mac, introduced the first security backed by conventional loans. Freddie Mac's mission is to provide stability, affordability and opportunity to the housing market. Freddie Mac is dedicated to putting homeownership within reach for minority populations. The Truth in Lending Act, Title I of the Consumer Credit Protection Act, is implemented by Regulation Z. This law requires lenders to disclose to buyers the true cost of obtaining credit, so that borrowers can compare the costs of various lenders. It is especially important that licensees not violate the advertising requirements of Regulation Z. The penalty for violation is twice the amount of the finance charge, or a minimum of $100, up to a maximum of $1,000. Lenders base their decisions about whether or not to grant a loan on the following criteria: the economy, the investment quality of the property, the borrower's ability to repay the loan. In order to lessen the risk, lenders need to determine the value of the property as collateral in the event that something unforeseen happens with the borrowers. It is important for the lender to determine the market value of a particular piece of property at any given point in time. Each piece of property must be inspected and appraised carefully to get a proper estimate of its market value. Summary review. Summary. A loan-to-value ratio, also referred to as LTV, is the ratio of the mortgage principal to the value of the property the borrowers are purchasing. Lenders use LTVs to determine the maximum amount of their loans. Lenders qualify buyers using what are called qualifying standards or loan underwriting standards. To qualify for a mortgage loan, a borrower must meet the lender's qualifications in terms of income, debt, cash, and net worth. In addition, the borrower must demonstrate sufficient creditworthiness to be an acceptable risk. Predatory lending practices typically involve one or more of the following: basing an unaffordable loan on the applicant's assets rather than his or her ability to repay the loan. Encouraging a borrower to refinance a loan so that the lender can charge high points and fees for the new loan. This is called loan flipping. Sometimes the borrower also pays a higher interest rate than with the original loan. Using fraud or deception to hide the true obligations of the loan from the borrower. The New York Anti-Predatory Lending Law puts considerable restrictions on high-cost subprime loans that are either first or second mortgages. The New York Anti-Predatory Law has several restrictions for high-cost loans. A borrower can bring an affirmative action for predatory lending practices against a lender or mortgage broker within 6 years from the date of the loan origination. If the borrower proves that the lender or broker violated the law, the borrower is entitled to actual damages, attorney fees, and statutory damages. Click here if you would like to open this summary as a PDF, which you can then print or save to your device. Chapter 16 Summary Chapter Conclusion. In this chapter, we have discussed definition of secondary mortgage market, important players in the secondary mortgage market, Regulation Z, the lender's criteria for granting a loan, predatory lending and subprime loans. In the next chapter we'll discuss land use regulations. Now it's time for your chapter quiz. Good luck! 1 of 17. What is not a criterion that lenders look at when determining whether to grant a loan? The borrower's age, sex, race, and religion. 2 of 17. Which of the secondary mortgage market agencies sets guidelines for conforming loans? Fannie Mae. 3 of 17. Any loan that exceeds the conforming loan limits set by Fannie Mae and Freddie Mac is called what? A jumbo loan. 4 of 17. A lender may consider an owner-occupied dwelling as less risk than a rental unit, because the owner will maintain the condition of the property better than a renter will. 5 of 17. When a lender is evaluating a buyer's ability to repay a loan, the lender looks at all of these items except which one? Educational history. 6 of 17. If the dwelling is owner-occupied, the lender may think the risk is less because the property will be better taken care of. In this case, the lender may require smaller down payment than if it was a rental property. 7 of 17. Regulation Z applies to which of these situations? $75,000 condominium loan. 8 of 17. Borrowers who fall into the below categories are referred to as subprime borrowers. 9 of 17. A loan-to-value ratio is the ratio of the mortgage principal to the value of the property. 10 of 17. When a qualified borrower is approved for a mortgage loan, the loan is referred to as what? A paper. 11 of 17. Which of the following is not a primary mortgage market lender? HUD. 12 of 17. When an underwriter is looking at an applicant's income, he or she wants to see income that is stable and enough. 13 of 17. Which of the secondary mortgage market agencies is now a private corporation? Fannie Mae. 14 of 17. When a lender convinces a borrower to refinance a loan and then charges high points and fees, this is called all of the above. 15 of 17. Determining a borrower's ability to repay a loan and evaluating a property are known as what? Underwriting. 16 of 17. Which of the following is a major credit reporting agency? Experian. 17 of 17. It is important for the lender to determine the of a particular piece of property at any given point in time. Market value.